Hey there, this is Prof. Aram, and in this video I'm going to provide an overview of financial markets and how a corporation fits within these financial markets, right? So assuming that this rectangle is your financial market, right, or capital markets, and then here we have the firm, right? Usually capital markets, right, provide capital or cash to the firm, and firms invested in cash flow generating assets, invested in factories or in inventory or other types of current assets or fixed assets. And hopefully those assets generate positive cash flows for the company. When the firm creates those values, creates the cash flows, they first of all have to pay the interest to providers of short-term and long-term debt, right? So we call that interest, and then they they pay dividend to the equity shares of the company, right? To the shareholders of the company, right? And then they need to pay, of course, taxes to the government, and whatever is left over, they're going to retain within the firm, right? So this is how financial markets or capital markets interact with firms, right? Now let's look at the different types of markets, right? First of all, we have the primary market, where the shares or the equities are sold privately to investors. We call this private placement. So these investors are like private equity firms or venture capitalists, right? So they agree to buy a portion of the company in return for capital, in return for cash that is going to be financing the growth of the company, right? So we call that a primary market or private placement scenario. The second one is a primary market in a public offering process, right? So in a primary, we call this also initial public offering process. So in an initial public offering process, we have three different entities involved. The first one is the firm that tries to become a public company. And then we have an intermediary, which is called an investment bank. And then we have the exchange and the individual investors like you and I, right? Or institutional investors. Okay, so the first part of this is called primary market in a public offering scenario, right? Meaning that the firm sells shares of the company to an investment bank, right? So the investment bank receives shares and pays the company the value of those shares, right? And then the investment bank turns around and sell the shares that received from the company to the public for a profit usually, and the public pays the investment bank, right? So the primary market in this scenario is here, right? The transaction between the firm and the investment bank. The second transaction is usually part of the secondary market. In fact, the secondary market can be looked at, for example, in New York Stock Exchange or NASDAQ are examples of secondary markets, right? Meaning that when the sales of the company is sold to public, right, then investors can start buying and selling these shares from each other, right? And these transactions actually, they don't have any financial implication for the firm, meaning that if I sell my share of Apple to my friend, right, and make a profit here, none of that is going to be realized for the corporation. I am the one who's making a profit because of the separation of the owners and the company, right? So the second, I mean, New York Stock Exchange or the NASDAQ are examples of secondary market, right? I hope you find this video useful and thank you for watching.